Happy Friday, Chris. I am glad to be back with you. Thanks to Dan for stepping in last week. I had this stupid, I don't know what it is, virus going around. I could barely talk last Friday. It was really weird. But I'm on the mend, so that's good. What a week. What a week for California. The fires we're having are absolutely tragic. Unbelievable, really, when you look at the destruction. I think it's going to be the most expensive fire in history. Last I saw it was like $250 billion in damage from the fires so far. Oof. And I don't think it's done burning yet. So the good news is the wind is changing, but the bad news is there's still a lot of cleanup to be done, and feel for the people losing their homes. And always interesting to watch the political dance when these things happen. But nonetheless, we're here to talk about the markets and everything going on. I do find it interesting. I don't know if you noticed this, Chris, but the fires going on, at least around here, have just dominated so much of the media and the news and everything that you almost have to like peel back all that just to see what's going on in the rest of the world, right? Because there's a lot going on in the rest of the world on top of that. But then this has just dominated everything for us anyway. So that's what we're going to try to do here today, is talk about what's going on in the rest of the world and with the markets and the economy as we prepare for President Trump to take office. I don't know if you caught it today, but they sentenced him and basically said Godspeed in the sentencing, which was a turn of events I don't think many people expected, but a nothing burger after all, I guess. So we'll see how that with that behind us, we can focus on the inauguration here in 10 days. And a lot of changes coming. I think it's creating a lot of imbalances in the markets, imbalances in the economy. We're going to talk about one of those big imbalances, which is the interest rates and what's going on with the interest rates, and surmise and hypothesize on why some of that is the way it is and how that could be impacting your assets, your investments, etc. Well, with all that said, we will be right back after this. Well, Hedge Eye coming home with a nice cartoon today, huh?
Yeah, their cartoonist he's on it.
He is great, isn't he?
Yeah,
I love whenever we can find one that works for the show.
Yeah, the wages continue to outpace inflation so far, but as you can see, the inflation is a rabid dog chasing them, and shows Uncle Sam there doing its best to hold the collar back, because we all know now, hey, inflation creates a lot of social unrest. That is for sure. So we've been talking a lot about the extremes in the market, extremes in the valuations, asking ourselves, do fundamentals even matter anymore? Right? Does pricing matter anymore? Is the old style of investing just dead forever? Maybe. I don't know. But this is from Callum Thomas, and he's showing the dot-com darlings from the dot-com crisis. And I will mention here that I shared with you, Daren, the most recent memo from Howard Marks, which anybody can look up. Howard Marks of Oaktree Capital Management. He talks about his remembrances of various bubbles, but the dot-com, he kind of centers on that. So this chart is from Callum Thomas, and he says earnings versus the price paid. The chart below shows how earnings did eventually come online for dot-com bubble stocks. Well, at least for some of those whom actually survived. but valuations came way down. In other words, all that glorious growth was in the price, and he stresses in the price. And that is a really difficult concept, I think, for even professional investors to get, is that yeah, you picked the right horse, yeah, you picked the right team, but also everybody else knew that and priced it to perfection to the point where you could never make money on it. And so here you see that the fundamental growth was there, but because the multiples were so high going in 2000, those multiples compressed and went way down. The feelings people had and the willingness that they had to pay a high price for those earnings deflated, and therefore the total returns on those stocks were underwater for nearly 20 years. And so the returns just did not materialize because of the high price paid.
So
And
Chris,
Buffett, yep.
just because some of our viewers probably don't know what the term multiples means, what does the term multiples mean?
So multiples usually is referring to the price of a stock as a multiple of its earnings. This particular chart is showing a price to sales, but it's usually a price to some, quantifiable metric. And so as an example, if Marx talks about this in his latest memo, if you pay 15 times earnings, that means all else being equal, it's going to take you 15 years of earnings to pay back your investment in that stock. Okay, but that doesn't take into account the time value of money. So actually, when you look at your interest rate over that time, it's actually going to take you longer than that to recoup your money that you invested into that stock. And so the higher the multiple, the more growth is priced in, the more good news is expected out of that stock, and that stock is going to grow fast enough that those multiples don't seem as high as they are now, because you've got some companies selling for 40, 50, 60 times multiples. And obviously nobody's willing to wait that long to receive their investment back. So they're expecting the stock to grow into those valuations. Possible, but not always likely, right? Especially on some of the bigger stocks that are as well covered as any. Now, this is from Richard Bernstein Advisors. They're showing, a similar kind of view on this, and they say a dose of reality. Only one of 1999's top 5 performing S&P 500 stocks outperformed cash over the next decade. So meaning that, if you bought one of the top 5 performers in 1999, then you would have been better off just in cash for 10 years. Now, having worked with many investors at this point and read about human psychology and noticed human psychology in myself and my friends and family, 10 years is an eternity. 1 year is an eternity for some people. So 10 years is a long time. So I just think that, much like you look at we've used the fire analogy in the past, because we went through the fires in 2017 in the wine country, right? And like the lack of something happening doesn't mean there's less risk, it means there's more risk, right? So the fact that the forest had not burned in so long actually built up the risk. It didn't mean there was less risk just because you looked back, 15, 20 years, 30 years, 50 years, whatever. They haven't burned, so I think we're good. No, that means there's actually more risk in nature, and in this case, I think there's more risk in the markets right now. So taking a look at sentiment, we did drop down just a little bit. Stocks, pretty much all the major indices are negative on the year now. So I would expect this bullish sentiment to continue to drop along with the prices. And we did have some bullish highs. This is showing the 1 year bullish high was in July, but we were pretty close to that bullish high at the beginning of December. So here we are, beginning of January, and things are totally different in terms of the vibe session in the market. We've got the CNN fear and greed index at 28, which is fear, and that's actually down from 33 last week. So the lower the number, the more fear. And the Bitcoin fear and greed index dropped all the way down to 50, which is neutral, down from 74 greed 1 week ago. So sentiment is shifting quickly, which I think is a characteristic of the modern markets, is that things just move faster. They move faster. Now, this is from Kevin Gordon at Schwab, and he says, wow, by way of Ned Davis research, I should say, wow, through the third quarter of 2024, U.S. households held a record 36% of their financial assets in stocks. So everybody, like we talked about towards the end of the year, everybody was all in on stocks. Everyone is all in specifically on U.S. large cap stocks. And so we've exceeded the prior peaks in this metric. So it's priced in. Everybody's expecting that same growth. Now, interestingly, I think there's some shifting going on under the tides. Anybody that keeps track of interest rates will know that they have been really just going straight up since the Fed lowered rates on their end in September on the 19th. That was also incidentally about the time that President Trump happened to take over in the betting markets, and the probabilities of not only Trump, but also the red wave happening started to increase. And so since then, the interest rates have gone pretty much straight up. Now, this is from Pinecone Macro showing the 10-year U.S. Treasury notes are down 5.9%. This was as of January 6th, by the way, so they're actually down more. Since the Fed began rate cuts in September 2024, this is the worst performance at this time of an easing cycle since 1966. So always talking about the extremes that we're seeing in the markets. How many times have we said this has never happened before, or this hasn't happened in X amount of years? We're there across many markets, things that are happening that have not happened in a very long time. And so we're at extremes in markets for sure. What kicked off the bad news today for the markets? Well, it was the good news, or seemingly good news, that unemployment wasn't as bad as we thought. So there's a brain bender for you. You think, gosh, unemployment wasn't so bad, and yet the market sold off like crazy. Well, that's because the market is pricing in the fact that the Fed's not going to be lowering rates anytime soon. So that kicked out all the rate expectations until at least October at this point, where, just a few months ago, there was as many as 7 rate cuts priced in. So no rate cuts in sight at this time. The market is expecting the Fed to have to stand pat because their metrics are showing that they're not given as much room to lower interest rates. Now, the contrarian in me thinks they're probably going to get to lower rates, but not because of the reason everybody expects and is hoping for, which would be, just to lower rates and help goose the economy. I think they're going to be lowering rates because recession. And if we look at the 3-month to 10-year Treasury, the yield curve inversion, Old Faithful, this would be the first time in history that we have had an inversion, that we've gotten to this point in an inversion or a disinversion and not had a recession. So maybe this time is different. I'm going to go ahead and expect that this time is not different, and that we're going to see the same thing that we've seen historically. And in recessions, the Fed typically lowers rates in response to that to try to stimulate the economy. Home builders. We're going to talk a little bit about the housing market because that's probably the most affected by interest rates. and it's the one that's kind of closest to the economy. And if you look at the home construction ETF represented here, or one of them that's available represented by ITB, this is not investment advice, of course, but just to give you a representation of what the market is expecting in this sector. And you see that those trend lines are starting to turn south. It's a pretty steep drop. Now, I think it's probably too early to say for sure that this is going to be a recession. I mean, look at the drop we got in 22, and somehow that was not a recession, although I think you could say that was a housing recession. But nonetheless, we're starting to see some weakness in the home builders. And that's because interest rates going higher also makes buying houses more expensive. Now, this is from Liz Ann Saunders, and she's showing data from Redfin. She says in 2024, a home buyer needed to earn an annual income of at least $116,782 to spend no more than 30% of earnings on monthly housing payments for a median priced home. Record high, and $33,000 more than typical household makes in a year per Redfin. So, there's these old rules of thumb and planning and advice on, how much of your money should you be spending on your house each month in order to have a comfortable payment, right? And that varies, but usually it's somewhere between 25 to 35% of your earnings. And you can see here that that's just not feasible with the average income and the median house price in the U.S. So with these big dislocations in the market, I think that not only are you seeing a lot of changes in the housing market, but also in the demographics of the country in terms of where people are going in order to be able to afford housing. And boy, these fires in Southern California are not going to help anything on this front, I'm sure. So housing starts. So if we look at the supply side of the market for a second, new houses, because you see that curl over on the home builders, the housing starts are actually are dropping off as well. Now, previously, you can see the gray shaded areas are all recessions, and typically housing starts drop going into a recession. Now we got that pretty major drop in 22, and so far there has not been a recession called, but still in the downtrend on starts. So no new supply on the horizon, or at least not enough supply on the horizon to lower the prices on homes. Then you look at, we've talked about this chart a few months ago, the existing home supply. And one way of measuring this is as months of inventory that are available. And you've got two measurements of this. You've got existing homes and you've got new homes. So this would be like new home builders. And we covered this, I want to say maybe in the summer, about how separated these two charts have become. And it's only gotten more extreme. So we've got 11 months of supply in new single homes, and we've got less than 4 in existing homes. And everybody knows why, right? A lot of the existing homes are already owned free and clear, or people have extremely low interest rates and do not want to sell and change their home. So there's no supply coming on for existing homes. So that just leaves new home supply. Well, home builders have been able to kind of cobble together enough rebates and incentives and such to get people into new homes over the last couple of years, even with interest rates higher. But it seems like the market is saying that runway is starting to run out a bit. And now the interest rates are back up over 7%. It's going to be more and more of a strain on those home builders to be able to offer those same incentives. Now, there's a metric that, when home supply is generally under 4, home prices are almost always higher in price a year later because of the lack of supply. But who knows, when you got 11 on the new home supply side, I guess it'd be good to know an average of the two. But typically that's going to be a headwind for prices on homes moving forward. Next chart here is the National Association of Home Builders Wells Fargo Housing Market Index, which includes all kinds of things like mortgage applications and homes sold, and it's kind of like their barometer of the housing market. And you can see going back to the 80s, typically when this number has gotten below 50, the market or the economy have both been struggling pretty strongly because housing in the U.S. drives a lot of the U.S. economy. You think about all that goes into buying and selling a home, all the people that are involved with that. And then, once you're in a home, all the spending that the typical person does to outfit that home. And so if the housing market slows down dramatically, that's going to put the skids on a lot of other ancillary industries. And you don't have to look very far to find realtors and mortgage brokers and such that are really struggling right now with the state of the current housing market. So a few more charts here. Home price appreciation since COVID has just been unbelievable, right? There's some of these states, I was just noticing Montana.
That is bonkers, man. Those numbers are bonkers.
Yeah.
Holy cow.
I mean, absolutely. The change has had to produce a lot of upheaval across the country. Florida, same thing, 70%, nearly 70% home price appreciation. And so it's creating a lot of migration across the country. That creates tension, right? And, it's not just people leaving one place, which creates problems, but also going to somewhere new, right? The infrastructure of some of these places. My sister, one of my sisters lives in Tennessee, and she just talks about the amount of traffic that has increased there that they're just not used to. And it's happened so quickly in the grand scheme of things that these places have not really been able to catch up in terms of their infrastructure. That will show from beginning of COVID till Q3 of 2024. And if you look at the next chart, this is kind of a cool thing. It shows U-Haul ranking of states net migration by one-way movers. So they've ranked the states. Red would be people moving in, and gray would be people moving out. And so you can kind of see where people are going. And a lot of people headed to the Mountain West and the Southwest, along with the South and Southeast. And so,
I feel like Washington, Idaho, Utah, Arizona, like that's just people fleeing California.
Yeah. Could be.
I mean, it's oddly shaped in a ring around California, which is just interesting.
Yeah, I wonder if the people were looking for what's like an hour and a half to 2 hour flight from California, right?
Yeah, exactly. Huh.
Yeah,
that's interesting.
Yeah, so the costs are also being driven up by in California for sure. Talking to a lot of clients that are really just struggling with the cost of insurance, and I don't see how that gets any better with the wildfires and natural disasters that have continued to hit. Because at the end of the day, an insurance company has to make money, and that's hard to do with these massive events where they're subject to billions and billions of dollars. And so not only do you have the cost of money very high in order to get a mortgage, you've already got the housing stock in California, as an example, is already very expensive. But then on top of that, you've got the ongoing expenses of insurance that continue to go up year after year due to these wildfire events that we've been just experiencing exponential growth in. So I think it's going to continue to drive a lot of demographic changes across the country over the next few years.
Well, Chris, just because it's Friday, I thought we would start with the U.S. national debt calculator.
Wow, thanks, bud.
Just to be uplifting, and we'll
Yeah.
just add another $250 billion. What's $250 billion in burned down homes and property in Southern California when you got $36 trillion in debt? This is the one that it's crazy, right? So for every citizen in the United States, we have $106,000 in debt. So every one of us, if we were to take all the debt and divide it by the number of citizens, the calculation would be about 106,000, 107,000. The debt per taxpayer, which is even more staggering, is $323,000. Now, how many people actually make $323,000 in the United States? I don't know what that number is, but it's probably not very high comparatively. Because I think like the average income's got to be somewhere like 80,000, something like that. I feel like I remember seeing a stat like that somewhere, but that's just mind-boggling to me. Let's see if any of these numbers have the average compensation anywhere.
Let me pull it up here. I just had, I think, on that housing chart. Let's see here. The median income. Let me find the notes here. Yeah. Okay. So it's around 80,000.
Yeah.
And that's household income. So that's not individual income. That's household income.
So that's even worse, right? Because that was taxpayer. So imagine there being 2 taxpayers per household on average. If you have 2 adults living in the house, let's just say, and those 2 taxpayers are averaging 80 together. And
yeah, that's the median.
Average,
that's the median home household income, right?
So let's just make the assumption 2 adults in a household, the average income somewhere around $40,000, and the average debt per taxpayer is $323,000. Like that's problematic. That comes off the rails at some point, folks. All right, so let's look at the S&P 500. So the S&P 500 is a measurement of the largest 500 U.S.-based stocks. These particular stocks, or the S&P 500, often what people refer to when they say, oh, the market is usually the S&P 500. It's a cap-weighted index. So what does that mean? A cap-weighted index means that the bigger companies, more of the allocation of the index goes towards the bigger of the companies. So like what you see on the screen here, Microsoft, NVIDIA, Apple, Amazon, Google, Meta, Tesla. These are the bigger companies. Back during the Nifty 50 areas in the 90s, XOM was the biggest box on this chart. And you can see how things have migrated. So when the big dogs, and they call these the Mag 7, go up or down, that really impacts the market. And this week, basically technology across the board got just slammed. And a big part of that was some comments that was made by the founder and CEO of NVIDIA, where he said that we're a ways off from robotics yet. They announced all these really fancy chips, etc., but we're still a ways off from hitting what we would need to see for mass adoption of some of these chips coming out. And so right now, the market's being completely driven by these tech stocks. And then they're saying, well, maybe it's not driving as much as perhaps the market thinks. And so that created a lot of the selling that's happening in the markets. All right. So now let's take a look at the charts. And the charts are just a kind of visual way to look at the behavior of the market, right? So we were just looking at those squares that represent the S&P 500. Now let's look at the S&P 500 on a chart. And when we look at the SPY, so this is what we just looked at on that heat map. This is the S&P 500. And you can see it's been a real steady raise movement upward, really all of 23 and 24, which we somewhat expected, right? Given that it's an election year and you would expect things to go up in an election year. And certainly the administration that's about to be outgoing did everything they could to make the market go up in the way of fiscal stimulus and many other tools. Well, now where we're at with the sell-off and currently in the market, this is the 4-hour chart. So every one of these candlesticks represents 4 hours in the chart. And I like to look at the 4-hour chart just from a shorter time horizon to help me kind of read the market. And you can see we, in the first 4 hours of the market today, we found a support at the 100 moving average of on a 4-hour chart, not a daily. We look on the daily though, we haven't sold off quite as bad. But I would say generally a bearish close today. And the reason I say that is because this was support right here, this 584, and then we closed below it and down into this territory here. And there wasn't a big wick buying up, right? So a wick looks like this. So you can see this was Friday, Thursday, Wednesday, Tuesday, Monday. So last Friday's candle, we saw that wick get bought up in the market, and that's support stepping in. So that's buyers when the price moves down, buyers step in and move it up. And then we close below that or right on that wick line there. So anyone that argues that there's no symmetry to the market is not operating with their eyes open, because it's amazing how that close today was right at the bottom of that wick from last Friday, which also coincided with this support region right here in the market. And so it's finding support right here currently, but the fact that it closed down into there and didn't get bought up at that moment is a sign of, I think, overall weakness in the market at the moment. And largely being driven because these tech stocks are selling off. And when these tech stocks are selling off, it creates a headwind for the market. All right, so that's the S&P 500 on a cap weighted index. And if we look at it, an equal weighted index, I mean, when we look at these squares, it means that every square is the same size. So it doesn't overweight it towards different stocks. So sometimes it's an easier way to look at the market and make some determinations as to what the market's doing. And you can see a similar structure, but more exaggerated, right? We found support right in this area, which happened to be exactly almost where the support was. In this case, not last Friday's, but that's looking roughly about 2 weeks ago, and found support there. What I will say, though, that on the equal weighted index, I think probably more downside in the future right here, because this is a double top right there. It's also coming in long. It looks like, it has this sell down and then consolidation, and then it's got that weakness right here. So I think we'll probably go down. I wouldn't be surprised if we take a look at this 100-period moving average on the equal weighted index. So that means that generally we'll probably see some selling off. Does appear to be a lot of support in these areas. So I would expect to see buyers step back in here coming into the next week. All right, so let's take a look at the ag, because I think we talked today about interest, everything being about interest rates, and really Chris talked about this earlier and how it's such a headwind for the home market. Interest rates are really a headwind for the overall market, and it's not really a good look when we have this long-term trend line up. We saw selling off, and now we reclaimed it and closed above that long-term trend line up. Because we closed right here, that tells you that's strength, and that interest rates are likely to keep going up. And so the question is, how are interest rates going up if the Fed keeps cutting rates? Well, it's a little more complex than that. So one of the incoming administration has made a lot of threats about tariffs. And when a government makes threats about tariffs against China, and China is one of the primary buyers of the Treasury, one of the ways they fight back against those tariffs is they say, well, fine, then we won't buy your Treasury bonds, which then forces the yield on the Treasury to go up because it has to go higher to induce more buyers to be interested in it. And that's ultimately can be difficult then for the Federal Reserve to control, because we're kind of at the end of a lame duck presidency here since the election. There's not really anybody doing anything. We're in this pause moment, right? So nobody knows really what's going to happen. And you have China saying, well, we're not going to buy any treasuries. And they're the marginal buyer, right? And that marginal buyer is what drives price more than anything. So if they're out of the market, that becomes problematic. Then we look at our dollar, right? So the DXY, and the DXY is a basket of currencies, and the dollar being one of those currencies in that weighted index. And the DXY shows us how strong the dollar is in juxtaposition to the other currencies or major currencies around the world. And the dollar strength is actually not ideal for US companies, because if the dollar is strong, it makes it very difficult to send our goods and services overseas. So if you think about what's happening, if you have all these threats of tariffs, threats happening, and then you have a strong dollar, that becomes a headwind for US companies. Because one of the ways that the other countries will fight back on tariffs is they'll say, fine, then, we're going to make it more difficult on your companies. What goes around comes around kind of story. So, and then we see the jobs data come out like we saw today, where it was pretty strong, right? So you can see the unemployment rate actually went down, and the non-farm employment change was higher than expected, pretty significant. Now, the work data, the employment data is usually very, very noisy, and they adjust this stuff. So I won't be shocked if they change it next month on what they said. But this idea that, wow, there could be more inflation in here than we expect happening. And you can see here, inflation expectations move back up to 3.3. So the expectations also came in that there is more inflation out there, and that's problematic for obviously lowering rates further. So then the Feds come out, or not the Feds, but then all the big banks came out today and said, oh, just guess what? We're not going to raise rates anytime soon. Or we don't think the Fed's going to raise rates or lower rates further, anytime soon. And then that becomes an issue, and so it keeps interest rates higher as well. So you got the China issue with the tariffs. You have the strength in the dollar issue. You've got interest rates moving up because inflation expectations are going up. All that to be said, President Trump, like him, hate him, don't like him, whatever, step up beside the politics, he's stepping into a tinderbox, and he's going to have a tough job ahead of him. A lot of what's been going on in the economy, kind of my overall read of it, is that the previous administration did everything they could to keep the market going, to keep the economy floating through the election. And then the fallout of that has to happen now. For every economic input, there is an economic output, and you don't always know where the economic output is going to come from. But you can't print money the way we're printing money and have that continue forever without there being some type of output. And the output in this case is rising interest rates, inflation, etc. A slowing down home market because people can't afford to buy the homes. I mean, when you look at the difference in buying a home just 5 years ago versus now, it is staggering on what it costs now to buy a home, which is pricing out much of the next generation, which then creates dissent between the generations and then foments economic pain and dissent amongst different classes of people in society. So with inflation heating up, that doesn't bode well for peace in the world, I guess I would say that. All right, so let's go take a look at gold, speaking of inflation. And when I look at the gold chart, that to me
hold on, Daren. We're not seeing the gold chart yet. Yeah, there we go.
Yeah. All right, so when we look at the gold chart, we've been watching this kind of wind up for a while. And to me, that just looks like a bull flag waiting to happen. So it's just consolidating on a, you could look at it as a bull flag. You could look at it as also, a triangle that's winding up to break out, much like we were looking at oil the last few weeks. And I think we're getting close to a breakout in oil, and I'll show you that in a minute. So that's interesting. So I hate to say it, Chris, but I called this one. Don't call them all, but I do call some.
Yeah. Yep. Nailed that one.
So you could see for weeks we've been talking about this kind of pattern, and I was like, hey, this is getting ready to break out. This is getting ready to break out, and you saw the breakout happen. But what's even more interesting is that's a shorter term consolidation. But if we look out in the longer term, there's a long-term consolidation, which is a much more problematic chart. If we keep breaking up and break out like this, that's not good for the economy at all. When oil goes up, I mean, it's interesting that, so prior to being a financial advisor, Chris, we were talking about this earlier, I worked in the fire service, and I worked for the Forest Service, and I also worked for UC Davis Fire when I was going to school. And I grew up with a dad who was a fire chief, and godfather was fire chief. And, you know, my family was in the fire service. So I've grown up just listening to fire talk. And a lot of people have been saying, well, how come all these houses burned down and none of the trees around it burned down, all over Twitter and X. And I responded to one. I'm like, well, because your house is full of things that are built with oil. They're combustible, right? I mean, you look at everything from the furniture you sit on to the stuff your furniture is made out of, to your desks. Everything we consume almost is just full of plastics and combustibles. And trees are actually meant not to burn on some level. And actually some trees need fire to burn or to grow and to heal. So when the economy slows down because oil is going up, it's because the cost of everything is going up. So if you have inflationary pressures happening, and you have inflation happening also because of oil going up, like, that's not a good combo. That doesn't look good. And this doesn't look good, right? So what we want to happen in this chart really quickly is for this to settle back down and for it to go, you know, this way or sideways. So, excuse me. But what I've also been talking about, now I talked about earlier in the show how this week's been dominated by fire news. One of the things that's percolating in the background, and I saw this headline last week, that there's a proposal on the table for Israel to take out Iran. And now is that window. I think had President Trump not said, hey, whatever you got to do, Netanyahu, to take out Iran, go for it, I think we would have been seeing them already go after Iran. But because it seems to be that Trump's in agreement that, and given that Trump did some pretty significant damage to Iran in his last presidency, I don't know that we're seeing anything happen quite yet, but this chart's telling me something's building in the Middle East. Something's getting ready to go off. Usually some type of macro event happens, a geopolitical event that drives up oil. And you can see, like, this was Russia, right? This is Russia going into Ukraine, right? So there's something building here. And just from a chart perspective, it's telling you that, like, it's been winding up. The pressure is cooking. There's more and more pressure until it finally breaks out. And we saw that happen down on a shorter time frame. And now we're looking at a medium to long time frame. So next couple of weeks is going to be a very, very interesting time, and will come through the markets pretty significantly. So I think it's a good moment, Chris, because in this chart, or in this show, we talk a lot about diversification, the importance of diversification, and the frustration that comes from diversification, because diversification in the last couple of years has not done well by people. And the people who have done really well in the stock market, it is because they've been highly concentrated in stocks like NVIDIA. And I think, you know, you say, well, it's okay that it's volatile because it'll go up and down. But I think if you're investing for the long run, I think it's a good week to remember that also with those returns that comes from stocks like NVIDIA, also comes these downs. You can just see this week, it was up 12%. And then this week it was down 12%. So good week to just remember why we diversify, right? So if all your net wealth is in NVIDIA, well, you had a pretty volatile week. It's pretty crazy to think that in 1 week it was up 12% and then down 12%. Like, that's pretty wild when you think about it.
Very wild. Yeah, absolutely.
All right. Take a look at ag. So ag is the bond index. So we've basically been through our worst 3 years in history in the bond markets. People who have bonds, who are generally more conservative investors, have been very frustrated with the markets. And bonds are not looking particularly good right now. We lost the 100-day moving average on the bonds. You can see it was an important support area here. We were supporting along it here, and we lost that. I mean, there's not a lot of buyers there. There's not a lot of people stepping back into buy. And with the inflation numbers coming in this week, I think it's more likely we see more downside on bonds, albeit we do have some support in this zone right here, and we're back into that zone. But you had this double top pattern here, and now we broke the neckline, so you can expect probably that distance of it. So my guess is we'll touch into the 94 range before we find too much support just based upon that chart. So I think interest rates continue to go up. I think that we'll see more downside on the bond markets for the near term. And I think until we get really see what the hand of the Trump presidency is going to offer, and we can start positioning to figure that out. Everything's rhetoric until it happens. And that's what we're watching closely over the next few weeks. But I was reading an article the other day where it's something like 100, they're planning 100 new executive orders in the first day. I'm like, that's mind numbing.
Yeah.
So we'll see how that goes. Yeah. That's going to be like, I don't know if I want to call it Christmas Day, but something like that, like the surprise day, like surprise, here's all these,
Yeah.
But I didn't mention that this was actually, I don't know if this is true, but like, I don't know if you saw the headline, Chris, this week that Trump wants to rename the Gulf of Mexico to the Gulf of America. And there was a lot of stuff going on before the fires caught on, and people were talking about that. But I heard this really interesting theory, which would make sense. One of the things that Biden has pushed through at the last minute is this to stop drilling in a lot of areas off the U.S. coast, so you can't drill for oil. And one of these people was surmising that Trump actually wants to rename the Gulf of Mexico to the Gulf of America, so that in the law, it's not forbidding you from drilling oil. And I was like, wow, that's 3D chess, dude. That is 3D chess.
Wow.
Let's take a look at VIX. VIX is a measurement of the complacency of those who trade the S&P futures, or looking 30 days out, what they expect volatility. And you definitely see that kind of build of volatility happening, right? Because it's going up. And so as it goes up, that typically means we're looking towards volatility. And the fact we're trading up, that's kind of interesting. So I think the next 10 days are going to be really interesting. There's a lot going on out there. And as always, we're going to be right there with it, trying to figure out how to read it and what the best way is to manage it. And but it'll be interesting, and I hope everyone stays safe, and we get these fires out soon here in California. And have a wonderful weekend, and take care.